what the last 10-year financials tell about the company. What is the intrinsic value of IEX and how much growth rate is required to justify the current market price? Let's find out in this quantitative analysis. Welcome you guys to this channel Business Charts. This is Fundamental Analysis series and this episode is all about Indian Energy Exchange. And this is a quantitative side of analysis. We will look into 10 years of financials, important ratios, analyst forecast, valuation of the company and shareholding trend. Sharia status of the company, which is passed in all complaint sections. A brief information about the company. It is operating in power exchange industry and around 14,000 crore worth business today and functioning from 2007. Presently 152 employees are working in the company. Let's start the financials from income statement. In the last 10 years, year-on-year growth sales numbers are increased at double digit and almost consistently increased, but at 2015 it is dropped by 5%. On checking the background, during 2015 CERC increased charges to open access participants in some states. So due to the regulatory change, there is a decrease in participants and volume on the IEX platform. So we can understand there is a business restrictions due to regulations. Other than that, even during pandemic year 2020, actually the sales up 1%. So company performed good even a bad situation. Last year sales are all-time high. So sales numbers are consistent and increase at a CAGR of 12.8% in last decade. And year-on-year net profit growth numbers are almost increased at double digit and consistent, except 2015 dropped by 2%. The CAGR is 15.2%, which is very good. Expenses side, there is no raw material cost because this is service based business, and the employee cost is just 10% of the sales in last year. Highest is 14% only in 2011. Employee expenses almost tripled in last 10 years from 5% to 14%. Other operating expenses is decreased from 22% of sales to 6%. It looks like most of the other expenses are fixed type, irrespective of the sales growth. Operating expenses and other income. This check is to understand how much the other income is contributing to the operating profit of the company. So because consistent higher operating other income is not good for any business. So in this company, on average, it is around 20% of the operating profit. It is high in my opinion. Less than 5 or 10 is a reasonable level. In the balance sheet side, liability side, there is no debt. But account payable is around 37%, which is yet to pay to creditors. And asset side, they have huge cash and short-term investments, which is around 81% on the balance sheet. So they can very well pay to creditors, and a very small fixed assets, negligible amount, and so very healthy balance sheet I can say. In the cash flow statement, operating cash flow is not very consistent throughout the decade. Last 2 years is increasing at threefold, 143% in 2021 and 129% in 2022. This is mostly came from divestment plan of IGX. Comparing to net profit, operating cash flow in some years is higher than the net profit and lower in some years. There is no particular trend. Spending on the capital expenditure, it is very low except only 1 year, 2018. On the year, company acquired trading software license from other company. So this is one-time cost, but which is also within the operating cash flow. The remaining balance is all free cash flow. That is very a huge portion. Company can use this amount to reinvestments. That is for organic growth, and acquisition, which is inorganic growth way. They can buy back own shares. They can reduce company's debt if they have any, and they can give dividends. As per company policy, 50 to 60% of profit they will distribute to shareholders because very low capital is required for expansion. So all three statements looks good. Next, ratios. In this section, we can understand company's performance. Profitability ratio is measured the profitability of the company. It is an important consideration for shareholders. If we look into the operating profit margin, it is very high, almost more than 70% in every year, and the last 5-year trend is improving. The latest operating profit margin is 84.4%. The net profit margin is almost more than 54% throughout the decade, and the last year it is even more than 70%. Means out of 100 rupees sales, 60 to 70%, 70 rupees is net profit. So that definitely very high margin business. That's why we all love this company. Return on invested capital, it is more than 34% in every year, and on last 5 years it is even more than 40%. So the return on invested capital is very high. Return on equity is more than 39% throughout the decade. The trend is even steady. Return on capital employed is greater than 41% in every year. In the last 4 years, it is even greater than 48%. Return on asset, it is in the range of 15 to 25%. Not extraordinary compared to other return, but it is even very good return. Return on asset mostly used to check the return in the capital intensive industries. So overall profitability of the company looks good. Sustainability side, leverage ratio is to measure company's ability to sustain its day-to-day operation in the long term. Interest coverage ratio is an important one for sustainability. This company earned more than 100 times to pay the interest obligation, so very healthy position. In any bad economic situation, company can pay their interest expenses easily. Debt to equity is 0. There is no debt, we know it. Liquidity ratio is to understand the short-term strength, how quickly they can pay their short-term debt. Current ratio, last year it is 1.5 times, so more than 1 time is very good. And the quick ratio, it is also 1.5 times, so they can easily close their short-term liabilities by cash and cash equivalents. And no need to sell any short-term assets to pay off the current liabilities. Efficiency of the management, how efficiently they are using their overall assets to generate sales. Asset turnover ratio is around 0.25. Higher is better, but it is not capital intensive business, so we can skip this ratio for this company. Company don't need to store anything as inventory for business operation, so it is 0. Cash conversion cycle, here all negative numbers. It means they have huge surplus working capital money. They collect cash from customers first, but later only pay to creditors after a few days. So they have surplus money to spend. More in negative side, more the better. Overall profitability ratio, long-term ratio, short-term sustainability ratios, every efficient ratios looks very good. And a few more key important ratios we can check. Number of shares, it is general check at the dilution point of view. The adjusted number of shares increased significantly during 2015 to 2018. The corporate action for this change is some preferential shares are converted into ordinary shares, and they brought back some shares in 2019. It indicates whenever management finds the market value is undervalued, then they will buy back their shares. So working capital amount is all positive, so short-term financial health is very good. On the net profit amount, they use around 40% for paying dividends in recent years and retaining 60% profit. Retaining small portion is enough for this low capex requirement business. So Piotrowski score, it is used to understand the strength of financial positions. It is combined score of profitability, leverage, liquidity and efficiency ratios. So 9 is the best and maximum score, and 0 is the worst and lowest score. Out of 9, the company score is 6 in 2022. The trend in last 5 years in upward direction. Ultimate Z score, this is to check the credit risk of the company. It is also the combined score of profitability, leverage, liquidity and efficiency ratios. This indicates whether the company is headed for bankruptcy or not. More than 3 is considered good, less than 3 is likely headed for bankruptcy. So we have to be cautious when it is less than 3. For this company, the score is 10.2, and throughout the last 5 years the score is more than 6. So it is in very good position. Book value per share is growing steadily in every year, and EPS also growing at almost double digit for every year except 2015. And we saw capex spending is very low, and comparing it to sales, capex is mid single digit only. On the other side, free cash flow is more than 40% of sales on average. So it is a cash cow business. Comparing the capex to operating cash flow, the capex spending is less than 8% only. So 90% is free cash flow only. Okay, overall in this ratio sections, everything looks fantastic. The next section, forecast. I have taken the forecast details from ICICI Direct July report for this company. Sales are expecting to grow at double digit, 16% in 2023 and 22% in 2024. Net profit is also expected to grow at double digit, 13% in 2023 and 23% in 2024. So sales and profit forecast remains at double digit growth, so very good. The next important section of the analysis, valuation. Here we will calculate the intrinsic value of the business. I believe value of a business is determined by cash inflows and cash outflows in the future and discounted to present rate. Cash flow models are looking into future, but we know only the past. We have to make some assumptions. It is usually what is the initial value, what will be the growth rate, and what is the terminal value, what is the present value of the future cash flow, the discount rate, these things. So for this company, we will when we look at the historical value, 1 year free cash flow is 751 crore. 3-year average free cash flow is 385 crore. 5-year average free cash flow is 260 crore. Here I have taken 3-year average free cash flow 385 crore as an initial free cash flow value. And historical growth rate for 1 year is 163%, 3-year 77%, and 5-year 30%, and 7-year it is 36%. 9-year free cash flow growth is 31%. So long term free cash flow growth rate is more than 30% during past decade. But I don't like to take more than 20% in any scenario. So I have considered 12% for first 5 years and 10% for second 5 years in conservative approach. For moderate method, 15% and 12%, and for aggressive 20% and 15% I have considered. And terminal value for calculation simplicity, I just considered the company will be sold at 15 times the free cash flow at end of the 10th year. So discount rate is 12%, that is risk-free rate of return 8% plus premium 4%. For these assumed values, the intrinsic value of conservative approach is 108 rupees per share. For moderate approach, 129 per share. For aggressive method, it is 171 per share. So I prefer to take the conservative only because we are predicting the future values. Our assumptions may go wrong. So margin of safety point of view, If in case I have missed something, then at least the conservative method will give me reasonable downside protection. I go with the intrinsic value 108, and at the time of making this analysis, the market value is 166 rupees. So it is overvalued by 1.5 times. More and more low price, we will have better margin of safety. So below 100 is considered undervalued in my opinion. So, okay, we got intrinsic value by assuming growth rate in DCF model. If we want to buy at current price, basically to justify the market value, reverse DCF model to be applied. The growth rate should be 17.3% for next 10 years as per the reverse DCF model. Comparing historical growth rate, 12% is well under the past growth rate. Even the growth rate seems okay. Even earnings multiple ratio seems very high. So it is currently around 45 times. So my approach for this business, 5 to 10% margin of safety from the intrinsic value is required, or less than 12% growth rate to be required as per reverse DCF calculation, and at the same time P ratio should be below 25. So the business is overvalued at current market level. Moving to the next section, shareholding. This is not a promoter owned business, it is professionally run business, so no promoter holding. Currently FIA holds 20.8%, DIA holds 21.7%, and retail investors hold 57.3%. The last 4-quarter trend of FIAs, they are net sellers, reduced from 37.7% to 20.8%. The last 8 quarter trend looks like DAs are not a bullish side, reduced from 36.6 to 21.7%. Of course, our retailers always bullish on this. They are buying from 34.3% level to 57.3% level. Frankly, I am not a big fan of this pattern. Anyway, to add some value to other investors' research, we have this. Yeah, that's it, guys. Our qualitative analysis report is available. We have a welcome gift for you. Download IND Money app, fund 10,000 rupees in US account, and get 1,000 rupees worth of Tesla stock. If you fund 5,000 rupees, you will get 500 rupees worth of Tesla stock. We will see in another analysis. Until then, thank you. Bye bye.